Hello, it's my pleasure to do this presentation for the second International Conference on Financial Technology and Business Analysis. My name is Shima Amini. I'm Professor of Entrepreneurial Finance at University of Leeds, and today I'm going to talk about climate change risk and its impact on performance of newly listed firms. So this presentation is based on a research paper that I am working on together with my co-authors who are Sophia Johan from Florida Atlantic University, Elnaz Kashefipur from University of Birmingham, and Abdul Muhammad from University of Leeds. So I start the presentation with the definition of climate risk. So according to Kruger et al. In 2020, we can define climate risk as the risks which are related to climate change and how they affect businesses, and the efforts by the businesses to mitigate the impact of these risks. So we can categorize climate risk into four main groups, which are physical risks, regulatory risks, and technological risks. So in terms of the physical risk, this is the risk which include extreme temperature, floods, droughts, and other natural disasters that have a negative impact on firm performance. When it comes to regulatory risk, that refers to the government policies which are aimed to control climate risks. For example, controlling carbon emissions and battling climate change by governments and how these policies would affect businesses. With regards to technological risks, these are the risks which originate from climate-related innovations to certain industries. For example, renewable energy threatens the fossil fuel industry, and this industry is at risks of technological risk. So what are the implications of climate change for investors? In recent years, there has been a lot of attention to climate risk and its implication for investors. In 2015, the global investment consultant Mercer has identified climate change risk as a significant source of portfolio risk for institutional investors to manage over the next 20 years. Also, in January 2020, Larry Fink, CEO of BlackRock, which is one of the world's largest asset managers, announced in his annual letter to CEOs that BlackRock will now make climate change central to its investment considerations. So, with regards to regulators and how they act in response to this climate risk, we can see that regulatory bodies trying to promote the financial market's attention to climate risk by encouraging both voluntary as well as mandatory disclosures of firms' exposure to climate risk. In a survey which was conducted by Kruger et al. In 2020, it was identified that 26% of institutional investors indicate that they are already incorporating climate risks into their valuation models. Also, the study by Alok et al. In 2020 suggests that fund managers also adjust their portfolios in response to climatic disasters. So, what about the climate risk and its effect for firm performance? We obviously expect there is a relationship between the climate risk and firm performance. Well, the fact is, the exposure to climate risk and how it affects firm performance is a main issue for financial market participants. And this is because climate risk cannot easily be hedged. We have natural disasters which have been amplified by climate change, and they can cause significant disruptions to firms' production processes, and they can impose substantial damage to the profit of the businesses. For example, the cost of equity capital on average is 92 basis points higher for firms who are headquartered in the US states, which are affected by climate risk. And this is the study result which was conducted in 2020. So we know that there is an effect of climate change risk on firm performance. But what is the overall effect of the climate risk on the economic activity? And we have evidence that there is this negative effect on the climate risk and overall economic activity. For example, the study by Foss in 2016 suggests that climate change destroys financial assets and disrupt related economic activities. Study by Bansal and Okwa in 2012 and Dell et al. 2009 show a negative relationship between temperature and economic performance. And more, there is a study by Covington and Tamotaram in 2015, which suggests that diversified global stock portfolio could lose 5 to 20% of its value if global warming reaches 4 centigrade or more. So, what about the relationship between climate risk and environmental, social, and governance will? So, ESG awareness is growing among the investors community, and investors increasingly incorporate ESG views in their portfolio more recently. And the climate change, which is a central pillar of the ESG, attracts a lot of attention in the investor community. So overall, committing to climate change generates value for stakeholders, builds resilience into firm operations and strategies, and help overcoming shareholders' uncertainty. With regards to investors to the initial public offerings, we see that IPO investors are aware of ESG, and as such, they consider climate risk factors in their investment decisions. So we know that with IPOs, naturally we have lots of information asymmetry. So this asymmetric information issue exists between underwriters, between issuers, and between different investors group. And this asymmetric information becomes greater in IPOs when we have a greater environmental concerns. So there is this uncertainty surrounding the possible effect of climate change risk on the firm performance, and that uncertainty might not be obvious to investors, and that might delay participation in IPO offerings. So the first hypothesis in our study is climate change risk having a negative impact on IPO firms' initial return. Our second hypothesis is about the effect of climate change risk on IPO underperformance. So we know that overall, we see underperformance for IPO firms in the long term, and we want to see What would be the effect of climate change risk on this underperformance? So there is a study by Hong et al. In 2019, and they find that firms which are located in countries with severe growth trends experience not only weaker profit growth, but also lower abnormal stock return. So they have worse growth prospects and also worse stock return performance. Another study in 2019 by Pankratz et al. Suggests that climate risk measured by high temperature reduces firms' revenue and operating income in 93 countries. So we have a global effect on climate risk effect on firm performance. So considering the negative effect of climate risk on economic activity and firm operation, our second hypothesis is that climate change risk has a negative impact on IPO firms' performance. So in our study, we are looking at US IPOs. So our sample is US firms. We collect these IPO firm information from SDC Platinum New Issue Database, WorldScope, and Thomson 1. And the time period is from January 2000 to the end of December 2020. So to include the IPO firms in our sample, we impose following 4 restrictions. First, the offer price should be at least $5. The IPO should not be a spin-off, privatization, an American depository receipt, leverage buyout, a real estate investment trust, a unit offering, a right issue, a limited partnership, a closed-end fund, or a financial institution. Our third criteria is that we exclude cross-listed firms as they are likely to be affected by the legal requirements of more than one country. Lastly, for each firm, we require data to be available on Compustat or DataStream. So after imposing all these restrictions, our final sample consists of 1,668 IPOs with complete data. So in our methodology, we are following the existing literature. We follow Hun et al. In 2020 and Javadi and Massoum 2021 when we use drought as a proxy for climate risk. So our main proxy for climate risk in this study is drought. We construct our drought measure by using historical PDSI data from the National Climate Data Center. What we do is that we take the average of the monthly PDSI across all geostations for each state year to aggregate the data at the state level for every year. We use negative of PDSI as the measure of climate risk. So when we have higher values, it indicates higher risk. We have another measure, and this is to measure the climate change in long-term trend as an alternative measure. So for constructing our trend variable, we follow Javadi and Massoum 2021 and estimate a trend stationary model to capture the differential time trends in droughts of each state. This is our methodology, which shows our model specification. We have performance as a function of climate risk and other control variables. So performance is post-IPO firm performance, which is measured as buy and hold return or market to book, which is industry adjusted. We have a vector of industry fixed effects control for differences across industries. We have year fixed effects to control for changing economic conditions across years. And we also have state fixed effects. So here is the first set of results that we have, and this is on the impact of climate change on underpricing. So the dependent variable in this analysis is underpricing, first day initial return of IPO firms. So our main variable of interest are the first two variables, the negative PDSI and the trend. And we can see, if you look at the first two row of this table, I have the coefficients for these two climate change risk variables, which are negative coefficients, and they are shown in a red rectangle. So you can see that there is negative effect on climate change risk, negative effect of climate change risk on IPO underperformance. So the higher the risk, the lower is the underperformance or underpricing. The second set of results is about the impact of climate change on long-term performance. Here we have two dependent variables. The first one is buy and hold stock return, and the second one is market to book. And again, we see the same trend as highlighted in the red rectangles. We see there is a negative effect of our climate risk factor on long-term performance. So the higher the climate risk, the lower the long-term performance. So we do a set of robustness tests, and the first and the most important one, we start with the possible endogeneity concern. And the reason is that it can be likely that IPOs which are located in a state which is associated with high climate change risk might have certain firm-specific characteristics which can be driving the negative effect on performance. So to tackle the endogeneity problem, we use entropy balancing method to explore if the effect is mainly driven by IPO firm characteristics or if the climate risk effect is still robust. To do that, we split our sample into high and low climate change risk using the sample median. We match the characteristics of IPOs located in a state with low climate change risk, which is our treatment sample, with IPOs located in a state with high climate change risk, which is our control sample. So how do we match specifically? We match based on the characteristics of the treatment group with the control group using IPO age, size, market volatility, IPO hotness, underwriter's reputation, IPO proceeds, and industry. So the two groups have same characteristics across the mentioned variables. So this is the result of our analysis after entropy balancing. And as you can see, we still see consistent result with our baseline regression. And that is the negative effect of climate change on underpricing and on longer term performance. So the higher the climate change risk, the lower the performance. So we find robust result after taking into account for the endogeneity concern. As another robustness check, we exclude California and oil and gas industry. And the reason is that in early 2010, California state experienced extreme and prolonged drought conditions that caused adverse impact on water usage, agriculture, wildfires, vegetations, and human health. So in California, greenhouse emissions are found to be contributing to the risks of extreme droughts. So to investigate whether our results are not influenced by the impact of emissions of greenhouse gases, we exclude California and also oil and gas industry. And we repeated our analysis. And we find that our results are robust and qualitatively similar to our baseline regression. Further, as a further robustness test, we looked at headquarters location. The idea here is that IPO firms with heavy concentration in the technology sector usually have a national wide or a global customer base. So their business operation may not be affected by their headquarters location. So we check the robustness of our result by considering the effect of high-tech IPOs and also the effect of those IPOs with international presence. To do that, we have interacted our measure of climate change risk first with high-tech dummy, so a dummy that takes value 1 if the IPO is in high-tech industry. And the result overall is that the impact of climate change risk is similar for high-tech and non-high-tech IPOs. Further, to examine the effect of international presence, we interact our climate risk measure with international intensity dummy, and this is a dummy which takes the value of 1 for firms having an international intensity above the median value in our sample. And overall, we find that the climate change risk affects IPOs negatively, regardless of the level of international intensity. So we find robust, consistent result with our baseline regression. So overall, we find a positive relationship between climate risk and underpricing, which suggests that the impact of growth is recognized by the market and is reflected in the first-day return of IPOs. We also find evidence that climate risk adversely affects the long-term performance of newly listed firms. The results of this study suggests that climate risk could potentially lead to substantial losses to investors. So investors should be aware of these risks when investing in the IPO market. Our results have also important implication for the states which are likely to be affected by climate change. And finally, companies should consider adopting policies to mitigate or hedge against climate change risk due to its implication for short-term and long-term performance. So that's the end of my presentation, and I wanted to thank you all for listening to this presentation. Thank you very much, and bye.